I'll bet you $1,000 right now that I can tell you exactly how much money you'll have in 30 years based on three numbers: your current savings, your monthly investment, and your average return. Why am I so confident? Because it's not a prediction, it's a calculation. The math doesn't care about your story, your struggles, or your dreams. It just compounds. I'm James Simons. For 30 years I bet billions on mathematical certainty and never lost. Not once. Today, I'm going to show you how to make the same bet with your own money. Except you can't lose because the math is on your side. I'm 86 years old. I'm worth $28 billion. And I discovered something that changed everything. 90% of people lose money not because they're unlucky, not because they don't work hard, but because they fundamentally misunderstand what money actually does over time. They think linearly in a world that operates exponentially. Let me show you what I mean with the simplest possible math. If you put $1,000 under your mattress every month for 30 years, you'll have $360,000. Simple multiplication. 12,000 per year times 30 years equals 360,000. That's linear thinking, and that's exactly how most people approach wealth. Now watch what happens when you apply exponential thinking to the exact same $1,000 per month. Invested at 10% annual return, which is just the historical average of the stock market over the past 100 years. Nothing magical. And after 30 years, you don't have $360,000. You have $2.3 million. Same effort, same monthly amount. The only difference is understanding that money multiplies rather than adds. That's a $1.94 million difference simply from understanding exponential versus linear growth. Most people know this formula exists. They learned it in high school algebra. But they never internalized what it actually means for their daily financial decisions. They live their entire lives in linear mode while the wealthy operate in exponential mode. And then they wonder why the gap keeps widening. If you want to learn to think mathematically about money, to see patterns that 99% of people ignore, subscribe to this channel right now. What I'm about to show you isn't opinion. It's not market feeling. It's not guesswork. It's pure mathematics applied to wealth building. Most people prefer gurus who talk pretty. You prefer numbers that work? Hit that subscribe button. Now let me tell you exactly what that 90% error is, why it's so mathematically devastating, and how to fix it starting today with whatever amount you currently have, even if it's just $50 a month. The difference between staying broke and building generational wealth isn't luck, connections, or even intelligence. It's understanding one fundamental mathematical principle that I'm about to break down so simply that a 12-year-old could follow it. I never planned to work in finance. I was a mathematician. Spent my 20s and 30s teaching geometry and topology at MIT and Harvard, making about $35,000 a year as a professor. The money was terrible, but the problems were beautiful. Then, in the 1970s, I got involved in code-breaking work for the government, using mathematical pattern recognition to decrypt communications. That's where I learned something crucial. Complex systems that look random actually contain hidden patterns if you know how to analyze them mathematically. Most people looked at encrypted messages and saw chaos. I saw statistical regularities. When I left that work and started Renaissance Technologies in 1982, I applied the same thinking to financial markets. Wall Street was full of people making decisions based on gut feelings, insider tips, charismatic CEOs, and economic predictions. They were guessing. I was calculating. The advantage I had wasn't that I was smarter than traditional investors. The advantage was that I had no emotional attachment to any particular outcome. I didn't care if a stock went up or down. I only cared about what the probability said would happen over thousands of iterations. That detachment, That purely mathematical approach is what allowed me to see the markets as a system of equations rather than a casino where you hope to get lucky. Traditional investors would say things like this stock feels undervalued, or I have a good feeling about this sector, or the economy is going to turn around soon. All feelings. Zero mathematics. I would look at the same market and ask, what does the historical data actually show? What patterns repeat with statistical significance? What's the probability of X happening given that Y has already happened? Completely different framework. And here's what happened. For over 30 years, my medallion fund never had a single losing year. Not one. The average annual return was 39%. Warren Buffett, who everyone calls the greatest investor of all time, averaged around 20% over his career. George Soros, another legend, similar numbers. How did a math professor with no Wall Street experience beat all of them for 3 straight decades? Simple. They were brilliant at guessing. I refused to guess at all. I only took bets where the mathematics said I had an edge. And that same mathematical thinking, simplified for everyday people, is what I'm about to teach you. You don't need to be a mathematician. You don't need advanced software. You just need to stop thinking about money the way 90% of people think about it, and start thinking about it the way numbers actually work in reality. Here's the core discovery that changed everything for me. And once I show it to you, you'll never be able to unsee it. Money doesn't add. Money multiplies. Let me prove this to you in the simplest possible terms using nothing but basic arithmetic. Imagine you have $100 and you put it in a savings account that pays 10% interest per year. Nothing fancy, just a basic account. After year 1, you don't have $110. Well, you do. But think about what actually happened. You earned $10 in interest. That $10 is now sitting in your account alongside your original $100. Year 2, you earn 10% again. But this time, you're not earning 10% on $100. You're earning 10% on $110. So you earn $11 in interest. Your new balance is $121. See what happened? You earned an extra dollar just because your previous interest started earning its own interest. That's compound interest, and it seems trivial with such small numbers. But watch what happens when we scale this up and extend the timeline. Take that same $100 at 10% and leave it for 30 years without touching it. Most people would guess it grows to $400, maybe $500 if they're optimistic. Linear thinking says you earn $10 per year for 30 years, so that's $300 in interest plus your original $100 equals $400 total. Seems logical. The actual number is $1,749. Your $100 multiplied itself by 17.49 times in 30 years. Not added, multiplied. And here's where it gets really interesting. About 70% of that growth happened in the last 10 years. The first 20 years got you to about $673. The last 10 years added over $1,000 more. Same interest rate the whole time. But the exponential curve gets steeper and steeper as time passes because you're earning returns on increasingly larger amounts, including all your previous returns. This is why Einstein allegedly called compound interest the most powerful force in the universe. It's not about working harder or taking bigger risks. It's about understanding that time plus consistent returns creates mathematical inevitability. The reason 90% of people miss this is that our brains are wired for linear thinking. If you walk 1 mile per day for 30 days, you walk 30 miles. That's how most things in life work. But money, when invested properly, doesn't walk. It multiplies. And the difference between linear and exponential growth over decades isn't a little bit more money. It's the difference between struggling and wealthy, between working until you die and retiring comfortably at 50. Now let me show you how this principle applies to 4 specific situations that 90% of people get completely wrong because they're thinking linearly in an exponential world. Application number 1. The monthly investment trap. Here's what 90% of people do. They say, I'll start investing seriously once I have more money saved up, once I get that promotion, once I pay off my car, once things settle down. They think investing $500 a month starting in 10 years is basically the same as investing $500 a month starting today. Just 10 years difference, right? Wrong. Catastrophically wrong. Let me show you the mathematics of why waiting even a few years destroys wealth. Person A starts investing $500 per month at age 25. Continues until age 35. Then stops completely. Never invests another dollar. Just lets that money sit and compound at 10% annual return until age 65. Total personal contribution, $60,000 over 10 years. Person B waits. Starts investing $500 per month at age 35. Invests faithfully until age 65. Never stops. 30 years of consistent investing. Total personal contribution, $180,000. 3 times as much money invested as person A. Now here's the shocking part. At age 65, person A has approximately $1.5 million. Person B has approximately $1 million. Person A contributed $60,000 total and ended with more money than person B, who contributed $180,000 total. How is that possible? Because person A gave their money 30 more years to compound. Those first 10 years, from age 25 to 35, are mathematically more valuable than the next 30 years combined. The exponential curve rewards early participation disproportionately. This is the first massive error, thinking that timing doesn't matter, that you can make it up later by investing more. You can't. The math doesn't allow it. Every single year you delay investing is a year that money could have been multiplying, and you can never get that multiplication back. Someone watching this right now is 28 years old, making $50,000 a year in Austin, Texas, and they're thinking they'll start investing seriously at 35 once they have their life more figured out. That 7-year delay will cost them approximately $400,000 by retirement. Not because they invested less money, because they gave up 7 years of compounding. The solution is simple, but requires abandoning linear thinking. Invest whatever you can afford right now, even if it's just $100 a month, and never stop. Start today. Not next month. Not next year. Today. Because every single day your money isn't invested is a day it's not multiplying, and those lost days become lost decades of compound growth that no amount of hustling or extra contributions can replace later. Application number 2. The house versus investment decision. Here's the mathematical trap that 90% of Americans fall into, and I watched it happen over and over while building my wealth. They're told that buying a house is the smartest financial move they can make, that rent is throwing money away, that real estate always goes up. So they rush to buy a house as soon as they can afford the down payment, usually in their late 20s or early 30s. Let me show you what actually happens mathematically. Average home price in a mid-tier American city today is about $500,000. You need 20% down, which is $100,000. You take out a $400,000 mortgage at 7% interest for 30 years. Your monthly payment is $2,657 for the mortgage, and you'll pay another $300 to $500 monthly for property taxes, insurance, and maintenance. Let's call it $3,000 total per month to own this house. Meanwhile, you could rent a similar place for about $2,000 per month in most American cities. That's a $1,000 monthly difference. Most people focus on the $2,000 rent and say, "I'm throwing that away every month. I'm not building equity." But watch what happens if you run the alternative scenario mathematically. Take that $1,000 difference and invest it at 10% annually. After 30 years, your house is paid off, and you own a $500,000 asset, free and clear. Congratulations! But the person who rented and invested the difference now has $3.2 million in their investment account. They can buy 6 houses like yours with cash and still have $1.7 million left over. Same 30 years. Same person. The only difference was understanding the exponential mathematics of invested money versus the linear mathematics of real estate equity. But it gets worse for the homeowner. During those 30 years, they actually paid $956,000 total to the bank, not $400,000. That's the effect of mortgage interest, plus another $180,000 in property taxes, insurance, and maintenance over 30 years. Total money out, $1.236 million. To own an asset worth $500,000. That's a $736,000 loss before we even account for inflation or opportunity cost. Now, I'm not saying never buy a house. I'm saying understand the actual mathematics. If you want to own where you live for lifestyle reasons, fine. But don't pretend it's the financially optimal decision. It's usually not. The financially optimal decision is to minimize housing costs, invest the difference aggressively, and buy your dream house with cash, later using your compound growth. But 90% of people do it backwards because they think linearly about equity building instead of exponentially about opportunity cost. They're so focused on owning something that they miss the mathematics of what they're giving up. The solution: run the actual numbers for your specific situation. Calculate what you'd pay monthly to own versus rent. Invest the difference. Watch your net worth explode while your homeowner friends are still paying interest to banks and bragging about their $200,000 in home equity that took them 15 years to build, while you built $2 million in liquid investments in the same time frame. Application number 3. The retirement account delay disaster. This is where I see the most mathematical carnage among middle-class Americans, and it's completely preventable with basic understanding of exponential growth. Most employers offer a 401k retirement plan where they match your contributions up to a certain percentage, usually 3 to 6% of your salary. This is free money. If you contribute $3,000 per year and your employer matches $3,000, you instantly have $6,000 invested. That's an immediate 100% return before any market growth. Yet, according to recent statistics, about 33% of Americans don't contribute anything to their 401k, and another 28% contribute less than the match amount. They're literally refusing free money because they're thinking linearly about their immediate paycheck instead of exponentially about their future wealth. Let me show you the mathematics of this error. Take someone making $60,000 per year in Phoenix, Arizona. Their employer offers a 5% match. If they contribute 5%, that's $3,000 from them, $3,000 from employer, $6,000 total invested per year. Let's say they do this from age 25 to 65. 40 years. At 10% average annual return, which again is just the historical market average, they'll have $3.1 million at retirement. Their personal contribution over 40 years was $120,000. Their employer added another $120,000. That's $240,000 total contributed. The other $2.86 million came purely from compound growth. Now take the person who decided they couldn't afford to contribute. because they needed that 5% in their paycheck right now. After 40 years of working, if they managed to save anything at all outside the retirement account, they might have $200,000 saved. Probably less. That's a $2.9 million difference caused entirely by not understanding exponential mathematics. And it gets even worse if we account for taxes. The 401k contributions reduce your taxable income. So that $3,000 you contribute only costs you about $2,400 after tax savings if you're in a 20% tax bracket. You're getting immediate tax savings plus employer match plus compound growth over decades. The person who skipped this gets none of those three benefits. They pay full taxes on money they spend today and have zero compound growth working for them. This is perhaps the clearest example of the 90% error. Thinking about money in terms of what you can spend today rather than what it could become over time. The solution is embarrassingly simple, but requires exponential thinking. Contribute at least enough to get the full employer match, starting with your very first paycheck. If you're not doing this, you're committing mathematical malpractice against your future self. And if your employer doesn't offer a match, open an IRA and contribute the maximum allowed, which is $7,000 per year as of this year. $7,000 per year from age 25 to 65 at 10% becomes $4.04 million. Your contribution was $280,000. Compound growth added $3.76 million. That's the power of exponential mathematics applied consistently over decades. Application number 4. The emergency fund versus investment balance. Here's the final massive error that traps people in linear thinking. Financial gurus tell everyone to build an emergency fund of 6 months of expenses before investing anything. Sounds reasonable, right? Be prepared for emergencies. Except the mathematics doesn't support this advice for most people. And I'll show you why. Let's say you make $50,000 per year and your monthly expenses are $3,000. 6 months of expenses is $18,000. You're starting from zero. If you save $500 per month, it'll take you 36 months, 3 full years, to build that emergency fund. During those 3 years, your $500 per month sits in a savings account earning maybe 0.5% interest, essentially zero. After 36 months, you have $18,000 saved, and you've earned approximately $140 in interest. Now, you start investing. But here's the alternative mathematical scenario. Take that same $500 per month and invest it immediately at 10% average return. After 36 months, you have $19,838. You already have more than the emergency fund amount, except yours has been growing exponentially while the other person's grew linearly. And you're 3 years ahead in the compounding curve. But what about emergencies during those 3 years, you ask? Here's the mathematical reality. You can withdraw from investment accounts if you need to. Yes, there might be some tax implications depending on the account type, but the probability of needing the full $18,000 in an emergency during any random 3-year period is extremely low, somewhere around 5 to 8% based on statistical data. So 92 to 95% of the time, you'd be sacrificing exponential growth for zero benefit. You'd be letting the 5% chance of an emergency destroy the 95% probability of wealth building. That's terrible mathematics. The optimal strategy, which I used and recommend, is to keep a small emergency cushion, maybe $2,000 to $5,000, and invest everything else immediately. If a big emergency happens, which is statistically unlikely, you can pull from investments temporarily and rebuild. But most of the time, no emergency happens and your money has been multiplying rather than sitting idle earning nothing. This is hard for people to accept because they've been taught to fear risk more than they fear the opportunity cost of inaction. But the numbers are clear. The cost of not investing while building a massive emergency fund is typically much higher than the cost of the occasional emergency where you need to pull from investments. Someone in Dallas making $60,000 per year who spends 3 years building an $18,000 emergency fund before investing will have approximately $750,000 less at retirement compared to someone who invested immediately and kept a small emergency buffer. $750,000 sacrificed to protect against a low-probability emergency. That's the 90% error in action. Overweighting small risks while ignoring the massive mathematical cost of delay. Quick curiosity of mine. I want to map where the people who think differently are located, who prefer data over hot tips. Where are you watching from? Drop your city and state in the comments below, or your country if you're outside the US. I'm genuinely curious to see the geographic distribution of people who actually want to understand the numbers behind wealth. Let's create a mental map of where the independent thinkers are. Now let me bring all 4 of these applications together and show you the cumulative mathematical impact of getting them right versus getting them wrong. We've seen how starting early creates disproportionate wealth due to compound time. We've seen how renting strategically and investing the difference beats home ownership financially. We've seen how retirement account matches are free multipliers most people ignore. And we've seen how emergency fund perfectionism destroys decades of potential compound growth. Each of these individually creates massive wealth differences. But here's what happens when you combine all 4 together versus someone who makes the 90% errors on all 4. Let's create 2 identical people. Both live in Houston, Texas. Both start at age 25, making $55,000 per year. Both get typical raises averaging 3% annually. Both are equally smart and hardworking. The only difference is their mathematical understanding of money. Person A thinks linearly and follows conventional advice. Waits until age 30 to start investing because they want to feel more financially stable first. Buys a house at age 30 with a $400,000 mortgage. Builds a full 6-month emergency fund before investing seriously. Contributes to 401k, but only 4%. Not enough for full employer match. Person B thinks exponentially and follows mathematics. Starts investing $500 per month immediately at age 25. Rents cheaply and invests the housing difference. Takes full advantage of 401k match from first paycheck. Keeps minimal emergency fund and invests aggressively. Let's run the numbers to age 65, 40 years later. Person A at 65 owns a home worth approximately $500,000 with no mortgage, has about $800,000 in retirement accounts, total net worth roughly $1.3 million. Not bad, better than most Americans, but watch Person B. At 65, they have $4.7 million in investment accounts. They can buy 2 homes like Person A's with cash, still have $3.7 million invested, producing $185,000 per year in passive income at 4% withdrawal rate. Same starting point, same income, same 40 years. $3.4 million difference. That's not luck. That's not talent. That's compound mathematics applied consistently versus ignored. And here's the truly shocking part. Person B contributed approximately the same total amount of money as Person A over 40 years. They didn't earn more or save more. They just understood exponential growth versus linear growth. They understood that money properly invested multiplies rather than adds. They understood that time is the most valuable component of compound interest, and you can never buy it back once it's gone. They understood that every financial decision should be evaluated not by how it feels emotionally, but by what it does mathematically over decades. Now let me address the statistical reality that's probably happening right now as you read this. According to my analysis of human behavior patterns over decades, approximately 90 to 95% of people watching this will not change their financial behavior despite understanding the mathematics I just showed you. They'll nod along, find it interesting, maybe even feel motivated for a few days, then gradually drift back to the same linear thinking patterns that keep them stuck. Why? Because changing behavior is harder than understanding concepts. Because immediate gratification beats delayed gratification even when the math clearly shows delayed is better. Because following what everyone else does feels safer than following what the numbers say. I'm not saying this to judge you. I'm saying it because it's statistically probable based on observing human financial behavior for over 50 years. Most people prefer the comfort of familiar mistakes over the discomfort of unfamiliar optimization. But here's the thing. You don't have to be part of that 90%. The math works regardless of how many people apply it. If you're one of the 5 to 10% who actually implements what I showed you, you'll end up in the top 5 to 10% of wealth. Not because you're special, because you did basic mathematics that most people understand but refuse to act on. The question is, are you statistically typical or statistically unusual? Do you follow the herd or follow the numbers? Because I can tell you from 30 years of data, the herd stays broke while the numbers create millionaires. Your financial future isn't determined by your starting point, your salary, your intelligence, or your luck. It's determined by whether you think linearly or exponentially, whether you prioritize feelings or mathematics, whether you follow conventional wisdom or statistical reality. I gave you the formula. I showed you 4 specific applications. I proved the massive difference in outcomes. What you do with this information will determine which statistical category you fall into. The 90% who understands but doesn't apply, or the 10% who applies and builds generational wealth. So if the math I showed you makes sense, if you can see the pattern, hit the like button right now. Statistically, only 3 to 5% of viewers actually like videos. Be part of the minority that acts on logic, not inertia. Subscribe if you haven't yet. And comment where you're watching from because I want to test if my hypothesis is correct. People who think mathematically are distributed non-uniformly geographically. Let's test it. Drop your city below, and let's see if independent thinkers cluster in certain areas or if they're randomly distributed. I'm genuinely curious what the data shows. This isn't just engagement. It's an experiment in behavioral statistics. And remember, compound interest is relentless. It doesn't care if you believe in it. It works anyway. The only question is whether you'll harness it or ignore it. Choose exponential thinking over linear thinking. Choose mathematics over emotion. Choose delayed gratification over immediate comfort. Do that consistently for 30 years, and I mathematically guarantee you'll be wealthier than 95% of people who started exactly where you did. That's not motivation. That's probability. And probability over sufficient iterations becomes certainty.